educational purposes only. So, make sure to definitely speak to legal counsel for any specific direct questions that you may have. And today's schedule, we're basically going to do a quick little intro that we just did, and then we're going to do a small little panel on passive investing versus the active side of investing. And let me go ahead and pass over to Mandy for a couple.
Awesome. Yeah. Thank you, Kev, my man. So yeah, we are super excited to keep all of this going through the shenanigans that are happening in the world. So thank you everybody for joining us. And these meetups are dedicated to multifamily investing. And a lot of what we end up talking about is very focused on the active side, that either buying for myself to own and operate a multifamily property, or for me to package a really big deal together and basically then sell shares of it in a way to passive investors. But what we don't talk a lot about is that passive investing side of the coin that's required for these bigger deals to happen. So we thought we'd take this opportunity over the course of the summer and throw a 3-part passive investing summer series. So the primary focuses of these 3 months will be, what is passive investing? Why do some people really just prefer to do passive investing over active investing? And then, how can you get involved in that in a bigger way? So welcome to part 1, you guys. That is, what is passive investing? So the way we've kind of structured that is your 3 hosts. I am kind of serving as moderator, and your 2 other handsome hosts will be my guests. We all have experience investing passively and being on the active side, but as they have a pretty significant history investing passively. We thought that I would just interview them to talk about, what is passive investment. So, let's really start with a big step back for anybody who's a big newbie and wants to start passively investing. Kevin, this question's for you. If we talk a lot about passive, we talk a lot about active. Just define for us kind of what is passive investing, what does that mean to you, and how is it different than active investing?
Yeah, for sure. So, you just sit back and collect checks is a passive investor, right? In essence, that's really what it comes down to. So, your responsibility is fairly limited as a passive investor. A lot of times your goal is to really educate yourself and to ask the right questions to the sponsors, get to know them, get to know what their investment philosophy is, and really make sure that they're going to secure and take care of your money. So from the passive investing side, in its finest form, you get to take advantage and benefit from all the real estate advantages, but you leave all the heavy lifting and work to the operators who have a lot of experience doing that.
Mm-hmm. So basically what I'm hearing you say is that passive investors are the people who give money into deal and basically buy those shares, for lack of a better way of putting it. And the active investors are the ones who put together the deals and are the ones finding them and getting the financing and all of that jazz, right?
Exactly, yeah. So specifically for multifamily investing, the passive investor is typically on the limited partnership side. So they will have some, they're the ones funding the project, majority of it, around 80% of it. And then on the flip side, they do have some minor voting rights in terms of if there's issues with the general partnership side.
Great, awesome, thank you. Brian, let's dig a little into that further if you don't mind. So, we say passive and active. We also say general partnership or GP and limited partnership LP. Can you maybe give us a little deeper understanding and definition of those terms?
Yeah, so the GP, which is the general partnership, that is typically, as Kevin said, the sponsor for the property. So they are going to be responsible for finding the property, putting a loan together, doing all the due diligence, doing all the active work up front. And once the property is under contract, they handle all the due diligence, do all the lease audits, get the loan from start to finish. Once the property is closed, they oversee any construction projects you do. They also asset manage the property. So they're overseeing all parts. That's why the general partner is active. The limited partner, as Kevin said, is the passive partner. in which they generally sit back and collect checks. So they don't do any of the work on the front end. They don't put their money in until the deal's ready to close, where the general partner will put their money in on the front end for earnest money, due diligence costs. The general partner fronts all of that cash up front, and the limited partner comes in and invests in the property right when they do close. The limited partner typically gets depending on the property, anywhere from a 6 to 8% preferred return on an annual basis, and then some kind of split of the upside in the property. Usually it's anywhere from 60 to 80%.
So, okay, I'm going to put this in terms that I know that my 70-year-old dad would get, right? So the passive investors, they give the money, they just collect these checks that basically is a preferred return, basically a return paid first. Of what we're seeing is usually 6 to 8%. And then if a property appreciates and is sold, they get to enjoy some proportion of that upside as well.
Yeah, the passive investors get their money back first. Typically, the way syndications are structured is the general partners get their money after the limited partners are paid back their initial investment.
Right. So the passive investors, the people who are the active investors don't get paid $1 until the passive investors have gotten their preferred return.
In most cases, correct.
In most cases, yeah. So definitely, we are not lawyers. Make sure you're reading those PPMs, but that is what I've seen as well. So just to better define, put a exclamation point on the end of it, general partnership and the active investment is kind of, they're used interchangeably, and limited partner and passive investor are also terms that are used interchangeably. So, all right, guys, let's say you have some funds that you've earmarked for passively investing. Brian, let's start with you. What is the very first thing that you do to seek out a passive investment? What's that first step?
Yeah, you want to do some research on what property type you want to invest in. So do you want to invest in multifamily or retail or office or industrial? I don't think a lot of people want to invest in retail or hospitality today, but there are all kinds of investments in every single asset class. So I think the very first thing is you narrow down the asset classes that you have interest in, do some research, and then decide which asset class you want to go forward in.
Kev, what do you do? What's your first step that you take?
Yeah, so after you kind of sold on a particular asset class, you start to really just get exposure to that asset class. So try and look at as many deals as possible, get an understanding for what the financials look like. And a lot of that comes by just, working with sponsors who are out there and seeing what kind of investments they provide. So looking at the deals, and the next thing I would say is getting to know those sponsors. So important to, know who that you're investing with, because it's a long-term relationship. These are big investments. It takes time for you to go through and increase the value of that property and move through the exit strategy. So it's like a long relationship. Like 5 to 7 years is a typical period of execution, and you want to work with somebody that you trust, that has a great track record, and you believe has the experience to execute.
Well, let's dig into that a little bit. Like when let's start with the sponsor piece, because I think that's absolutely huge. I've been personally, I'll tell you guys, I've been part of deals where I lost money because I should have done more due diligence on a sponsor. So I'm super interested to know, Kevin, when you're getting into passive investments, exactly what sort of a checklist you have in terms of underwriting that sponsor to make sure you can trust him or her.
Yeah, so due diligence is, has multiple components to it, but specifically on the sponsorship side, questions that I'd ask are, are you personally investing in this deal? Because that shows their buy-in on this particular project. You want to make sure that they have skin in the game, so your goals are aligned. You want to see what their track record is. So, have they had successful exits in terms of this particular business model? You want to know specifically what they've done in challenging situations, because when people go through challenges, it really shows their true character. So if they have examples of, setbacks or difficulties, and that they have grit, they're going to get the job done. And you also want to know what's going to happen, like, hey, who's on the team? So typically it's a sponsorship team. You don't want it to be a single person, because there could be a point of failure right there. If it's just one individual wearing all the hats, it's difficult to manage these entire projects. And I mean, if possible, you want somebody who's kind of been vetted at times, and vetted through a recession would be ideal. Somebody who's seen, when the economy changes and, how they've adapted to that environment. That's not always the case. You can kind of vet in a lot of different ways, but that would be a nice bonus.
Okay. Do you end up talking to other investors that have previously been passive investors in that sponsors deals?
I haven't in my passive investments, but that's a fantastic thing to do. You really want to see kind of what type of reinvestment there is in previous projects. So what I mean by that is, what percentage of the current investors had invested previously in other projects that were successful, or rolled it on to the next one because they saw the benefits of how that sponsor is operating. So referrals are absolutely critical across the board for almost any service in real estate.
Mm-hmm. Brian, let's take that to you in terms of vetting a sponsor. How important is that to you? What are some things that you do in order to make sure you're making a good choice?
Yeah, it's very important. And, like Kevin said, you want to, try to work with somebody who has a track record, and, ideally you've been referred to them. Both deals that I've invested in passively, I knew the sponsors. So I already had, a little bit of background information on them. I'd known about some of their prior deals. In the very first deal, I'd actually worked with them from the brokerage side. So I had, a lot of information about them, but I always want to ask some detailed questions about the opportunity as well. Specifically, what challenges do they see with the property? I want to know why they think that property is a good deal, and what they feel like the major risks are that they're undertaking, and how they plan on overcoming those. So another thing that's important is asking about operating reserves. I think it's, especially in times like this when you don't know when rents might just stop coming in for a short time, you want to make sure that everybody you invest with has planned for a good chunk of operating reserves.
Yeah, it makes total sense. Have you ever made an error in terms of selecting a sponsor or a deal?
I don't think so. Both deals that I'm invested in so far, they've been going pretty well. They've been, I think, 2 years and 3 years. So, everything's going well. I think in both cases, the preferred return was suspended, just, given the times right now. But I expect them to pick up. And one good thing about preferred returns, even if the operator does suspend them, they always have to catch up the investors first. So the investors are getting that money back plus that return, even if it's temporarily paused.
It makes it a real win if you're a passive investor, right? How about you, Kevin? Is there anything that you've learned from a mistake that you've made in terms of selecting a sponsor or a deal?
So on my passive sides, not yet. Fortunately, the sponsors are very communicative, which is important, especially right now as things are changing. For my personal investments, I've made plenty of mistakes, and you hope that there's enough wiggle room in the projects to kind of allow you to learn through it at times. And, especially when times are really difficult, suspending the payments is pretty reasonable because there's uncertainty. So that seems to be a very strategic method for a lot of operators, which, I support because, right now the environment is changing. So you have to be a little bit more conservative, and knowing that the preferred return will get caught up as you are moving through the investment and rehab phase.
Mm-hmm. Well, sorry, but I didn't mean to cut you off. I have, as I mentioned, I have made a mistake. So I do kind of want to throw out there that moving forward, and something I tell the people that I'm coaching in this, I absolutely, if it's a one-man show or just a couple-man show, run a background check on them. That $15 is going to potentially save you $100,000, if you have more full knowledge as to, if they've had bankruptcies, at least understand the why, because a lot of people had property issues in 2008. If you're comfortable with that why, I still consider moving forward, but at least know the full story of what you're getting into is what I would encourage you to do. So.
Yep.
Kevin, this one's for you too. Let's start out there. In terms of questions that you ask, so now you've decided you like the sponsor, you're going to get the offering memorandum. what are some questions you ask about the property or the numbers specifically?
Yeah, so the next thing I'll do is dive into the actual investment itself and the investment strategy. And in multifamily, the name of the game is value add. So that is the
define that just for the super newbies, just in case.
For sure. So, as an operator, they're typically building up fantastic relationships to find deals that are underperforming, or maybe that are at the end of their investment cycle for the previous investor. And because of that, there's the ability to go into some of these units, rehab them up to the new market norm, and then increase the rents. So that's one aspect of going in and increasing the value or value add. Another would be, let's say a building's been owned by a family for a long, long time and they're self-managing. And before it's producing great income for them, but they just kind of let it, kind of age, and they're not operating as efficiently as it could. So they don't have energy efficient lighting, LEDs, or low flush toilets, or maybe the utilities aren't sub-metered. So there's a lot of reasons why and methods that you can go in and decrease your expenses or increase the rents that'll ultimately increase the net operating income and increase the value of the property.
Got it. So let me say that another way. In terms of multifamily real estate, its value is an exponential factor of how much money it makes. What is the net income you get after operating the property? So can you increase the amount of money it brings in by bringing rents in higher, or can you decrease, I'm sorry. Thank you. Thank you for muting, sorry. Or can you decrease the expenses and therefore make that operating income higher and exponentially increase the value of the property? So thank you. So now you're digging into it. You want a value add property. What else are you looking for?
So the other aspect is, did their market analysis support the types of rents that they think they can get? So, you can use CoStar, you can use apartments.com, Rent-A-Meter. There's ways to kind of see what types of rents you can achieve for that area. But the best way is really to do a comparison of the properties nearby. That would be your, comparison, and see if those rents are something that you can actually achieve. So I kind of dig into that aspect. And, a lot of times these are markets where you have really strong performing demographics. So a lot of people love Texas, Arizona, the Southeast, parts of the Midwest, and these markets all have favorable demographics in many instances.
Great. Okay. So basically, what's the value add / upside? What are those upsides reasonable? And does the kind of the demographic stuff make sense? So,
yep. Yeah, those are a couple things.
All right, Bri, how about you? What are your kind of primary questions you ask once you've decided this sponsor is somebody I'm going with that's deal specific?
Yeah, like Kevin said, you want to dig in a little bit to the actual property and the underwriting. I try to review the underwriting myself and, check out some of the rent comps, look at some of their assumptions. I want to make sure that they're not underwriting with really high projections just to make sure that the returns look good. They can say, hey, it's going to be a 17, 18 IRR. We're going to double your money in 3 or 4 years. But if you look at it, and their projections are just, so aggressive, you want to verify that first.
Got it. Well, let's maybe simply define a couple of those things. Underwriting is just doing the math on the property, right? And what you're saying is, there's a lot of, you don't know what's going to happen in the future. So when you're a syndicator putting together a deal, you kind of have to make some educated guesses, some assumptions, right? So I think this is a perfect segue into something that's kind of one of my biggest things that I like to raise flags about is, what assumptions in running of those numbers do you think are the trickiest for syndicators? So if I'm a new passive investor and my eyes are going through the operating memorandum and the numbers, which assumptions are ones that I want to make sure are reasonable?
I think the rehab budget and then post-renovation rent projections are probably the two most important. Okay. A lot of people, especially if they don't have a lot of experience, they underestimate the cost of rehab. And anybody here who has done any rehab units knows that you don't get very far with $5,000 per unit in rehab. So If they're assuming a $5,000 per unit full renovation, increasing rents by 15, 20% after that, that's a red flag. So you want to verify what the rehab budget is. I want to know what they're spending the rehab budget. If they have $1 million rehab budget, I want to know not necessarily how it's broken down dollar by dollar, but what's the percent going into CapEx and what's the percent going into units.
Mm-hmm. CapEx being
capital expenditures, parking lots, common areas, anything common, not in the units directly.
Great, very cool. Kevin, what about you? What are some super tricky assumption numbers that you want to make sure that you have a full understanding of?
Yeah, so instead of the tricky side, one of the items I look at is kind of like the sniff test. So I'll jump back to that after, but operating expenses, depending on the asset class and how it's being managed, one of the rule of thumbs is close to 50% operating expenses. So if you see a deal where, the expenses are 30%, 40%, and it's a B minus C class property in particular areas, you really want to understand what's the story behind that. So it's really just trying to catch red flags that maybe don't make sense within the property, and asking what the story is behind that and how it's been fact checked. So it's a good general rule of thumb. Other items, so once again, the construction, that's really that can be a moving target. So usually, your property manager, as long as they're really vetted, they have great contacts. You want to get multiple quotes for that. Mm-hmm. The other aspects would be along the lines of vacancies. So there's going to be the actual vacancy, which is like physical vacancy of the particular property, and then economic. So,
define the difference.
Physical vacancy is people living in the property, and then economic are the people paying. So sometimes there can be a disconnect as to how much money is being collected, and you really want to understand what the story and background is behind that if there is that difference. Mm-hmm. So that's Great. One aspect that I'll look into. And concessions, you want to know if they're paying this particular tenant base a lot. You'll see a lot of concessions right now to motivate people to move into units. And right. Sometimes that's expected based on your value add strategy, but those are a couple items that I would take a look at and ask questions on.
There's a couple that I'd like to add too. Both of you gave incredible examples, totally stuff I look at too. One thing that especially I think we'd all agree that we're closer to a top than we are a bottom. So, prices are a big question mark in the future, right? And as Kevin defined earlier, a value add property means that we're going to capture a bunch of appreciation because we've really made that net operating income go up on an annual basis. Well, the exponential factor that's measured on is a function of the cap rate, right? So a syndicator has to kind of guess what they think the cap rate will be when they're going to sell the property in between 5 to 7 years. Everybody calls that an exit cap or a terminal cap rate. That's a complete guess, you guys. So if right now they're buying a property at something like a 5 cap rate and they think in 5 or 7 years they're going to sell it at a 4 cap rate, that is a mega red flag, because cap rates can't compress much more than they're at right now. So the one thing that I pay the most attention to is, what is your exit cap? Why is that your exit cap? And to kind of piggyback on what both the guys said, if we're doing a real big rehab, if it's a huge heavy lift of a rehab and they haven't factored in additional vacancy while that rehab is happening, and the rent bumps are going to happen immediately like magic, I mean, it takes time to do a rehab, and a person is usually not living in that unit while you're doing that rehab. So just a couple of additional things to mull around on.
To add to that, this current state of economy is, we're still finding out more information as we go. April may have been generally positive. That's why there's kind of like a sticking point between the sellers asking price and the bids coming from the buyers. But the one thing to keep in mind also with underwriting is, what do they project for the rent increases? Because that is part of the strategy. A lot of times people expect a 2-3% year-to-year rent increase, whereas maybe their operating expenses could stay flat at 2-3%. So you just want to make sure that you can stress test these numbers on your own to see if the numbers will still withstand, changes in the economy and still be able to pay the note and not have a capital call from your sponsor.
Mm-hmm. Well, maybe tell us a couple of things. You talked about stress testing. What are, 2-3 rules of thumb or stress testing things that you personally do when making sure things pass the sniff test?
Yeah, so, I'll potentially, depending on the market, drop the rental increases to like 1% or 0, just to see what that does to the IRR, which is your time-weighted return over the period of the investment. I'll see if the expenses kind of stay flat. I'll bump up the capital expenses to see maybe if added another 20% to it. I'll also kind of change some of the economic vacancy to see what kind of levels we need to be at where the property is still cash flowing. So that's definitely more of an art than it is a science. And I'd say it's more of a science when you get to really, really know your submarket. So you're really trusting your sponsors and operators to provide that, that very detailed and thorough information. Mm-hmm. At the same time, talk to your counterparts and colleagues to see what their thoughts are on it. So we have a strong community here, and obviously everybody wants to grow their wealth. So.
Mm-hmm. Brian, how about you? What are a couple of stress test go-tos that you look at?
Yeah, I think one main one is vacancy. If you can increase vacancy to 20 or 25%, does the property still break even? You don't want to have a property where if you increase vacancy to 15%, you're underwater. You want to make sure that it can sustain at least 20 or 25%. And if you look back at average vacancy at the time of the last recession in, say 2008 to 2011 for that particular submarket, most markets are between say 9 and 13% vacancy. So I always try at least 20% and say, okay, if things really hit the fan and we're only at 20% economic occupancy every month, can we at least break even and pay the mortgage?
Brilliant. That's my favorite one too. So kind of let's switch the scope of that a little bit, because you both have been on the active side of this too. So you've dealt with investor relations and what it means to work with your passive investor counterparts as the active investor. So I know we need to be very careful and speak in generalities here as a reminder. But tell us a couple of go-to questions that new passive investors end up asking when you're onboarding them. Brian, why don't you start with that?
They want to know, generally, I think one of the first things is, what's the time frame of the investment? I'm going to give you X amount of money. When can I start seeing a return on that investment? And when do you expect me to get all of my money back? Mm-hmm. So any active investor needs to be prepared to answer those couple questions. Passive investors also want to know about your experience, your track record. How many properties have you done before as a sponsor? How many properties have you taken through a construction process? So depending on the scope of this particular project, they're going to want to see if you've completed other projects similar to scope. Okay,
great. Kevin, how about you?
Yeah, so in terms of some of the questions, like who is on the team and kind of what are the individual roles and how does everybody fit together to execute this strategy? They also ask like why this particular property, how did this property come about? Because that's always interesting to know what the story is regarding this investment and why it's a good investment. They'll also ask about the particular submarket. So, what the comps show, why these comps are actually true comps in terms of like the rental price that we can achieve. And, a lot of times the returns, they'll want to know about the returns and what kind of, period it'll take to mm-hmm. get those payments and what the payments look like.
I love it. Well, let's kind of put a pretty bow on this and then we'll turn to some Q&A. In your estimation, as a real estate investor on both sides, why invest passively? What are some top reasons?
I think a couple of top reasons to invest passively. One of the benefits is you get cash flow without spending any time. Most times, if you're buying a house, you want to do a fix and flip, you're trading your own time for that money. In this case, you're essentially purchasing cash flow. So you invest in a property, and once you invest in it, you do your initial diligence on the sponsor up front. You're just getting passive income going forward. The second big reason I think is tax benefits.
Mhm.
Oftentimes, if the sponsor is doing cost segregation, the property, even though you're cash flowing positive, it can very oftentimes show as a loss on your tax returns
Mhm.
for the first several years of the property. So I think those are two of the main reasons that people want to invest passively.
Great. Kevin, what are your top reasons?
Yeah, I mean, the big one that I see is time. It takes a lot of energy and effort to really operate well in any real estate class, asset class. So if you're engaged and passionate about it, then there's a lot of wealth that can be built on the operating side, but it's nice to be able to sit back and collect that passive income where you can spend your time on the things that you love to do most. So I would say that's a big one. Also, the types of returns you can get from real estate, depending on the timing of the investment, the cycle of the market, the tax benefits, the potential appreciation. There's a lot of different levers to real estate that allow you to, in many cases, get higher returns than you would on some of the other types of investments. So generally speaking, I believe everybody should diversify, but a lot of people in this group are biased towards real estate and the ability to create value out of that asset class.
Mhm.
So you give up a little bit of return, but that's so somebody else can take control of it and basically grow your wealth for you.
Right. So
And
what
then-
I'm hearing,
then-
sorry?
Okay, if I jump in here for a second.
Of course, yeah, please do.
First thing, what the stuff that you guys are putting out is great. I love the information. The only one thing that I would add or change on what I've heard in the conversation is I put a higher priority on the vetting of the sponsor than the deal at all. I put a higher weight on the sponsor, and I think people that are interested in being passive investors should be doing a lot more vetting the sponsors
Right.
now. And then when a deal comes around from that sponsor, you've already done a lot of the work ahead of time. And the thing is numbers are easy to manipulate.
Yeah.
And if you've got a lot of confidence in the sponsor, there's less chance that they're going to be messing around with the numbers. That if they've got a good track record, they've got a reputation to uphold, they've been in the business for quite some time, they've got an established team, they're not going to be messing around as much as somebody that's desperate to get their first deal there. And
Right.
they're going to be twisting and turning because they may not act like they're desperate, but they need that money coming in because this deal's going to close. So I definitely put the priority on the sponsor as far as looking at them first. And then when they start coming around with deals, going and seeing, okay, what deal do you have now? I do want to plug a book, if you don't mind, that I have nothing to do with and I get no money on, but Brian Burke on Bigger Pockets. It's actually produced by Bigger Pockets. I put out a book called The Hands Off Investor, and it's fabulous. It's got intimate details on everything that you as a passive investor would need to look at. So it's a great book.
Awesome.
And then lastly, the point as far as I've had several hundred investors in my different syndications over the past 12 years, and very, very, very few of them have really done much in the way of due diligence, either on me as the sponsor, on the PPM, on the operating agreement, because they didn't have the knowledge. They had the money, they trusted me, and they invested with me, which, it's worked out. But the thing is, I'm not saying that is the way to go. You need to do that due diligence. You need to understand everything that's in the operating agreement. You need to understand that PPM as well. It's real important. And most passive investors don't take that time. So it's extremely important that they vet the sponsor at least. And at least get that comfort that the sponsor is doing the right thing.
Do you mind if we dig into that a little bit? Because I totally agree with you. I always say that you can change the spreadsheet, that ain't gonna change the property. That ain't gonna change what happens. So what questions do you ask? You said underwrite the sponsor. What does that mean to you? What are some links you would go to in order to make sure that this is a person who's trustworthy?
Well, you guys have mentioned a lot of the stuff. You know, you want to do a criminal check on them. You want to find out about their office. Maybe go and visit their office, see their physical office, see how they're running things. But you know, you could say talk to investors, but of course they're going to refer you their best investors or their brother-in-law or their sister or whatever. So, you know, it's difficult to do that part of it. But you could also talk to property managers. What property managers have worked with them? How are they to work with? Find other maybe vendors that have worked with them and see how they've done. There's many different things. A lot of them you guys have mentioned, but you know, finding out what they're doing. You know, talking to their employees. You know, if you get the opportunity to go see their facilities and go to their properties, see some of their properties and see what the properties look like. You know, talk to the staff. See, you don't want to put the staff on the spot, but you know, see if the staff are happy. See if they're professional. See if they talk to you in a professional manner. That has a lot to do with the property management company, but it still goes to the top. It still goes to the top to the owner, that the owner is going to make sure they're working with a property management company that's running a professional shop.
Awesome. That's really great advice. It seems so obvious now hearing it to talk to vendors, but you know, I hadn't thought of that. Thank you for that. What a great surprise, Jeff. Thank you for your additions.
No problem.
Anything else anybody has to add in terms of some questions for Jeff, Kevin, Brian, myself, before we go into a little bit of networking, speed dating, as it were?
Mandy, one thing I'll add, just to kind of piggyback off what Jeff said, and Jeff, those are all great points. If anybody here is thinking about passively investing, one action item that you can take away from today is, like Jeff said, start vetting sponsors now. That way, when a deal comes up, you don't have to do your homework on them then. You can start, you know, pick out 6 or 8 sponsors and narrow it down to the top 2 or 3, get on their email lists, and then you can start looking at the deals that they're coming out with, but you'll already know that that's a sponsor you want to work with going forward.
Great point.
Yeah, I'll even piggyback on that a little bit more. This is probably one of the best times to do your research on sponsors, because there's going to be a transfer of wealth. I mean, nobody has a crystal ball, but you know, the way it's shaking out with the type of employment we have, there may potentially be some really good opportunities coming up. So learning right now, feeling comfortable with the types of investments and vetting those sponsors it's a great time to do that.
Great. Well, thank you all for your input today, and really looking forward to continuing this summer series with next month is going to be a panel of investors who do choose to primarily invest passively. So we'll get a chance to pick their brains on how they look at things, and you know, looking forward to continuing the process.
Cool. And then I'm going to put us in breakout sessions for, you know, 3-4 minutes so that everybody can, you know, introduce themselves, network a little bit. Actually, I'll make it 5 minutes so you guys can kind of chat, give your background, and hopefully make some new connections. So stay in here. Let me try and figure this out. I'm really hoping you guys get unmuted during this process. So I'll get a text message if not. So any last messages, Mandy, Brian, you guys want to chat about anything or last comments from anybody?
Just a reminder about the next 2 portions of this summer series that we're very excited about. And like we mentioned in our breakout groups, these will be uploaded to YouTube, so that if you have things you want to go back to, you'll certainly be able to do that. Or if you want to educate other friends, please